If you're turning 64 this year, I honestly feel for you a little because you just missed one of the most powerful retirement opportunities the IRS has allowed in years. But if you're 60, 61, 62, or 63 right now, you are still inside a small window that most people your age don't even know exists. And today I want to walk you through exactly what that rule is, who it applies to, and what you should consider doing before the end of the year. Before we get into the numbers, I want to address something I hear all the time. A lot of people immediately think, I can't afford to put more money away right now. And that's completely understandable. Life gets expensive, especially as you approach retirement. But stay with me for a moment, because that exact thought often ends up costing people thousands of dollars later. In many cases, people actually have more flexibility than they realize once they look at the numbers clearly. Everything I'm about to explain comes straight from the IRS. It's based on their official announcement and Notice 2025 to 67. This isn't speculation or internet rumors. These are the rules currently in place. For 2026, the standard 401k contribution limit is $24,500. That's the base amount available to everyone who participates in a workplace retirement plan. It increased from $23,500 the previous year. Now, if you're age 50 or older, the IRS allows what's called a catch-up contribution. That means you're allowed to contribute extra money beyond the normal limit to help boost your retirement savings as you get closer to retirement age. For people between 50 and 59, that catch-up contribution is $8,000. So when you combine the regular limit of $24,500 with the $8,000 catch-up, the total contribution limit becomes $32,500 per year. But here's the part that many people have never heard about. If you're between 60 and 63 years old, there is a special rule created under a law called Secure 2.0. Instead of the normal $8,000 catch-up contribution, you qualify for a larger one often called the Super Catch-up. That amount is $11,250. So if you fall into that 60 to 63 age range this year, your total 401k contribution limit becomes $24,500 plus $11,250. That's $35,750 you can place into your 401k for the year. And that's only one account. Your IRA has its own contribution limits entirely separate from your workplace plan. For 2026, the IRA limit is $7,500. If you're over 50, you can add another $1,100 catch-up contribution. That means you could potentially contribute $8,600 into an IRA on top of your 401k. When you add those together, you're looking at the ability to protect nearly $44,000 from taxes in a single year. When I first saw those numbers laid out, I double-checked them myself just to be sure. But that's exactly what's listed in the IRS documentation. So why does this window exist in the first place? Think about where many people are financially between ages 60 and 63. In many cases, the biggest expenses of life have already passed. Children may be financially independent. Mortgages are often close to paid off. Careers are usually at their highest earning years. Lawmakers recognize that this stage of life can sometimes give people the ability to accelerate retirement savings in a meaningful way. So they created a short window that allows larger contributions during those years. The catch is that the window is temporary. Once you reach 64, that special catch-up disappears and you return to the standard catch-up limits like everyone else. There are no extensions and no exceptions. The opportunity simply closes. And the surprising part is that many people never use it. Not because they couldn't contribute more, but because they never realized the rule existed. Let me give you a simple example. Imagine someone named Gary. Gary is 61 years old and works as a project manager at a mid-sized company. He earns around $85,000 per year and has been contributing about 8% of his paycheck to his 401k for years. That works out to roughly $6,800 annually. Gary always assumed that was a reasonable amount. He never really revisited the numbers. Then one day his daughter sends him a video from the Rule by Senior's channel explaining these contribution rules. Out of curiosity, Gary logs into his company's HR portal for the first time in years. He looks at his contribution percentage and starts doing the math. He realizes something surprising. Because of the super catch-up rule, he had the ability to contribute far more than he realized. In fact, He had been leaving tens of thousands of dollars of contribution space and used each year. Gary decides to make a change. His budget doesn't allow him to contribute the full maximum, but he increases his contribution rate to 25% of his paycheck. That puts about $21,000 into his 401k over the year. Then he opens a Roth IRA and begins contributing $500 per month, which totals another $6,000 annually. In 1 year, Gary goes from saving $6,800 to saving over $27,000 toward retirement. Same job, same income. The only difference is that he finally understood the rules available to him. And because Gary is still inside that 60 to 63 window, he has 2 more years to keep taking advantage of it. That could mean tens of thousands of additional dollars growing inside tax-advantaged accounts before retirement. That's the power of simply knowing the rules. Now let's talk about what this might mean for your own situation. If you're still working full-time, this is usually the easiest scenario to adjust. Take a few minutes to log into your payroll or HR system and check your current contribution percentage. Many people set that number years ago and never looked at it again. See how much you're contributing right now and compare it to the limit you're allowed this year. If there's room to increase it, even slightly, adjusting it earlier in the year makes the change much easier. The earlier contributions start, the smaller the increase per paycheck. If you wait until the last few months of the year, you may need to increase contributions significantly to reach the same total. If you're working part-time, the rule can still apply as long as your employer offers a 401k and you're receiving earned income through payroll. The main restriction is that you can't contribute more than you earn. But many part-time workers overlook something important. Your IRA contributions are separate from your 401k. Even if your income limits how much you can place into your workplace plan, you may still be able to contribute to an IRA. Another situation that surprises people involves married couples. If one spouse is retired but the other is still working, the household can still benefit from these rules. If the working spouse falls within the 60 to 63 range, they can use the super catch-up through their 401k. And there's something known as a spousal IRA. That means the non-working spouse can still contribute to an IRA using the working spouse's earned income. Two retirement accounts, both receiving tax advantages, supported by one household income. For many couples, that's a strategy worth discussing with a financial professional just to understand the details clearly. If I were in your position, here's what I would do next. Start by figuring out your personal contribution limit based on your age this year. Write it down somewhere visible. Then log into your payroll system and check your current contributions. Most people are surprised by what they find. Calculate how many paychecks remain this year and how much additional contribution would be needed to move closer to your limit. Often the change per paycheck ends up being smaller than people expect. While you're reviewing things, take a quick look at your IRA situation as well. Even small monthly contributions can add up over time. It may also help to review monthly spending habits. Sometimes small adjustments, subscriptions that are rarely used, or expenses that quietly add up, can free up a few $100s each month that could be redirected toward retirement savings instead. Over several years, those small changes can make a meaningful difference. When you make contribution changes, it's also a good idea to keep records of confirmations and track IRA deposits, so everything is clearly documented for tax purposes. One thing to remember is that the IRS will never personally remind you about opportunities like this. They publish the rules, make them available publicly, and that's where their role ends. The people who benefit are the ones who learn about the rules early enough to act on them. And that's exactly why conversations like this matter. If this information was helpful, consider sharing it with someone you know who might be in their early 60s. Many people have never heard about this rule, and one simple conversation could genuinely help someone strengthen their retirement plans. And if you enjoy learning about the real changes happening with retirement rules, taxes, Social Security, and Medicare, make sure you're following Rule by Seniors. Every week, we break down the updates that actually affect people approaching retirement, in simple language without confusing jargon. Thanks for spending a few minutes here today, and I'll see you in the next video.